Mr. Porcelli.
Sorry to take all the time.
So we're going to fight?
Well, we had...
I don't like fighting with you.
But Tom has the reasonable take, and I, of course, have to find some problem.
Mm-hmm.
So the reasonable take is, yes, they're going to trim by a quarter because inflation overall is improving and so forth. I'm feeling a little agitated when I look at the core at 3.6, when I look at stocks going to the moon.
Sorry.
Well, annualized 3 months, because the last 3 years have been 3s.
Oh, is that the game you're playing? Okay.
I mean, 1 month you can dismiss, 3 months you start to go maybe not. And I like Nancy Lazar's work on this. The needs inflation is up 4.5%, more wants inflation is up 1%. And then you just look at the markets. Spreads are the tightest they've ever been. Stocks are at all-time highs. Bitcoin is at 93,000. I mean, this to me feels like an economy that's more overheating than undershooting.
Yeah, I don't know if it's quite overheating, but I'm sympathetic to your general stance of, but things are actually okay, right? I mean, and which, by the way, that's a victory anytime. I do think that there are some sort of little cracks that maybe we should talk about, but I think as it relates specifically to the CPI report, I think what you have to keep in mind is a couple of things. One, and I'm so happy that Powell said this a couple of meetings ago, where he said, look, policy was calibrated for inflation that was meaningfully higher than it is today. So in that context, it's reasonable to pull back some of that aggressive tightening. Not that they want to get into an easing stance. They just don't want to be as aggressively tight. So I have a lot of sympathy for that general view. And so, yeah, I do. I think that they're going to cut again in December. And I think the Fed's forecast right now is about 100 basis points of cuts next year. I have actually no problem with that at all, which will basically get you to just north of neutral. Again, let's recognize we don't totally know when neutral is.
Go for it.
A point of information.
Yeah.
If you guys call up the November 25 Fed funds cards, this is a game we play with the back room the whole game, right?
They're very good. They're doing a great job.
The fact that they like that game is actually
well, they don't like it. Anyway, there it is. I like it. So Tom just told us the Fed has 100. That's 3-4.
Look at that chart.
That's the market for November 2025.
That's where they think
a little bit of
rates
dissonance there is all I want to point out. That the market now is a little more hawkish.
This is telling us they'd only cut by about 60 more basis. Well, a little bit more, 75 between now and next
another
September.
Quarter, and then maybe 50 left or something like that. Exactly. Now, I think the importance of that is that it's an old forecast from the Fed, the 3-4.
It is.
Fascinating question what they will put in December.
Because we will get the projections.
I can easily see that scaling
coming back.
Scaling back, in other words,
so you'll be somewhere between 3 and 4 cuts next year, I think is where they'll go around.
If we just forgot about neutral, just throw it out the window, and just said...
Which is what Powell's sort of doing in some way.
Totally. He's very open to this. And we just said, based on inflation for the last 3 to 6 months, I'm talking about the core, based on what's happening in financial markets, would you hike, keep rates the same, or cut right now? What would the data tell you?
I think what we then have to do is we then have to rope in labor, right? Because he's been very focused on labor, which I think is the right thing to do. And when I think about some of the sort of the labor data that we've been getting, right, I think people love to just focus on the payroll report. But I think there's so much more than the payroll report, right? So if I look at something like the quit rate, or if I look at the labor differential, if I look at the hiring rate, right, which, by the way, I totally recognize.
It's been low,
Which, by the way, those are not household sort of names, right? Everyone knows the unemployment rate and things like that. But these other things, they are not the outliers. The outlier was 2 months ago when we got that 223,000 job gain. That was the outlier. So there's been enough, I think, softening in the labor backdrop for the Fed to justify continuing to take back some of the aggressive tightening.
I've made this point before. I'd like to make it again. And for this point, I'd like in the back to put up a 10-year yield going back a year. Okay?
Which goes back to the all-time highs, basically.
It goes back to the all-time highs. Let's talk
about
about how much easing has actually been imparted to the economy since the Fed pivoted. Okay? And when you think about why the economy is strong now, perhaps why the unemployment rate remains low, look at that. That's really fabulous. Now, a lot of it's been taken back, but there's still that big dip in there that has helped out. My problem is this. If you stop now, you have imparted easing to Wall Street and to companies with access to capital markets and access to
I don't even think you've imparted it to them. Look at the 10-year. It's just proving your point.
But they've been able. They had a big refi wave in the summer, and they were able to capture some of that. If you stop now, you halt the possibility of passing along lower rates and some easing to small business and to consumers.
But not if the long end. If the lever, so the idea was, and this is going to be my sophisticated chart, if we can put this on camera. The idea was...
It's an air chart. I've patented those.
They cut the overnight rate.
Right.
And the long-term rate, it was supposed to go like this.
The parallel shift.
And that didn't happen. So they cut the overnight rate, and the long end rate went like this.
Yeah.
And so my argument is, if they were to raise the short end rate, would the long end rate go like this and just give that stimulus, like you're arguing,
here's
spread
the
that out more
problem
in
with
the
your
economy.
argument, I might say. And if Paul McCulley would hear, he would do a dance on the table.
He'd be upset.
And he would be upset. He'd say, well, you're locking in an inverted yield curve.
Yes, 100%.
And what was supposed to happen, you had the first chart right about that the long end was supposed to go up while the short end came down because you were supposed to get a steeping of the yield curve to restore normalcy. That did not happen quite the way it was expected.
Yeah, and I think, just keep in mind, I think the market, if you think back to the beginning of the year and sort of how expectations on cuts or not have evolved, it's been all over the map. And so I think what's happened recently is the market is now taking back some of the aggressive cuts that they thought were going to happen even just a month ago. And so that has really sort of forced sort of 10-year yields higher on the back of that. I mean, we're leaving the election out, and I'm guessing we don't really have time to get into all of that.
Election?
But do you think austerity, I mean, I was joking, but you could see if they cut meaningfully or even move us in the direction of cutting, government spending, narrowing the deficit, that'll take some stimulus out. It could bail Powell out.
Yeah, and look, I think their ability to cut spending is near zero, right? I mean, deficits are only going to sort of increase from here. And as much as I love, having someone like Elon Musk in there to try to look at this stuff, I just think he's not going to be very successful. So I think at the end of the day, and Steve showed that chart, look at 100 years worth of 10-year yields. You could do this, right? It's out there. Schiller, I think, Professor Schiller has that chart out there, going back 100 years, more than 100 years. If you look at this idea, people keep on talking about higher for longer and et cetera. It's not higher for longer. It's actually normal for longer, right? The 3 to 5% zone on 10s is where we almost always sit over the last 150 years.
Can I just make one point, which is this emerging, very subtle commentary from the Federal Reserve, which is that they're kind of saying to the fiscal authority, look out, we may have to lean against this. Lori Logan made a very subtle comment about rates being too high and the Fed may lean against it one way. And then Mr. Schmidt from Kansas City, the new Kansas City Fed president, I'm just going to read this. Political authorities could very well prefer that deficits not lead to higher interest rates, but history has shown that following through resulted in high inflation. An independent central bank insulated from immediate political pressure and guided by a clear inflation objective has historically been an effective means for achieving and maintaining low and stable inflation. Is that a little shot across the bow? What are you hearing when you read that?
Exactly what you're hearing. And I think we leave it there. This is where we pick things up now. Not so much, I think, even for December, but for the new year.
Yeah, I think that's right.
Gentlemen, thanks.